Hello everyone, my name is Lachlan. I write for Monday Morning and I'm also an analyst on Exponential Stock Investor. Now today I'll be talking a bit about dividends and earnings season. So there's a lot to discuss today. What I want to do is look at a couple headlines first, then I'll dive into the charts. I'll give you a couple tools if you are looking for various dividend stocks, and then I'll finish with some comments about dividends and dividend yields, and hopefully give you a bit of insight there. So I hope you stick around. It should be a good update today. I've got a headline here from the AFR, which is the Australian Financial Review. So the headline is "Profits to Post 20% Recovery." And it's a good article. It's well written. There's a lot of interesting data in there, and I'd encourage you to check it out. But I guess one of the things that I always remember is I read these mainstream outlets like the Australian Financial Review, Reuters, Bloomberg, etc., to find out what not to say and what not to think. Even though they're very respectable outlets, they have a certain bent to them that can quickly get you in, I think, the wrong headspace as an investor. So I'll just do a quick scan through this article. Earnings season is coming up very shortly, and a lot of people will be looking for stocks that can make a move based on guidance beats, etc. Now, there's a lot of commentary in here, and I discussed this in the most recent Monday Morning article. So there have been a number of retailers like Nick Scali, JB Hi-Fi, that have sort of released positive updates recently, and one of the main points in this article is that there will be this shift to cyclical stocks. So that means stocks that could benefit from an increase in consumer spending. And I'm not completely against that view of things, but in here you also get some commentary that suggests that the big banks could be valuable, and people have always looked at the big banks as these sort of beautiful sources of dividend income. And I've always, I guess, resisted this view, partly because of technological reasons, fintechs, the likes of fintechs, and crypto potentially being on the horizon. But I'll just dive into the charts now. Sorry, one more thing I want to bring to your attention is inflation jumping faster than expected. So this is a big theme for us in Exponential Stock Investor. It's a key underlying factor in our thesis that commodities will do extremely well in the coming years due to a potentially super hot inflationary scenario. So I'm actually not surprised to see inflation increase faster than expected. But let's just get straight into those charts. So I've got the Westpac chart here. Now, it looks like a lot of other bank stocks. And it's starting to tick up from about October onwards. Now, that's when lockdowns were on the cusp of easing, and I've sort of mentioned in the past how Australian consumers could have a lot of dry powder even if the RBA doesn't. But I guess the interesting thing here is that if you look into the WBC, which is Westpac Banking Corp, price to earnings, it's trading at about 34, I believe, which is really high for a bank. Now, CBA's price to earnings is lower, and I guess that would mean for some people that, oh, good, I'll go out and buy CBA shares as opposed to Westpac shares. Now, price to earnings doesn't mean much for me in my small cap world, but let's look at the CBA chart here. So there's a little descending wedge formed here, and then it's ticked up far stronger than Westpac. And I guess size matters when it comes to banks. They get economies of scale. So that could be explaining why CBA is moving faster than Westpac. But another big source for dividends for investors in Australia has often been A-REITs, which are real estate investment trusts. So I've just got the A-REIT index here, which is looking pretty steady at the moment. And then, yeah, it started to move in November. Now that covers all of the ASX 200 A-REITs. So I guess there's a bit of strength there if you're looking for dividends in the form of an A-REIT. But I guess my comment on that would be that you have to be very selective with A-REITs because although we're looking at sort of going back to work in the office and commercial A-REITs or commercially focused A-REITs were absolutely smashed, the key thing to remember is that it could take quite a while for those commercially focused A-REITs to recover because people are still quite hesitant to jump back into the office for a very obvious reason. But that being said, I am more bullish on the property market than I am on the prospects of the Big Four. So with that being said, if you're a dividend investor, there's a good tool I've got for you today. I've previously mentioned Market Index. They've updated their website. It's a lot smoother and it's quite responsive, so definitely check it out. Now they've got a dividend yield scan tool here, which I think a lot of novice investors would sort of flock to. But if you look at this dividend yield scan here, now you've got some very high yielding ones at the top here. And then the interesting thing to note about this particular scan is that if you scroll down the 1 year returns on all of these, or sorry, nearly all of these stocks, most of them are absolutely smashed this year. And I'll make a final point about dividend yields at the end. But the other tool I wanted to draw your attention to is the Morgan's reporting season calendar. So they provide a bit of commentary with all the calendar entries here. So it's quite comprehensive. And if you're looking at sort of diving into what's going to happen in the earnings season, this commentary can be quite helpful in giving you a little taste of what to expect. But I guess with earnings, there's been this sort of consensus out there that because the Australian macroeconomic picture is improving, you'll see incredible earnings. And the point I'm making to the article I just wrote is that it could trick you into jumping into stocks that might not be particularly good from a growth perspective. You may think, oh, the earnings are good, the dividend is going to improve, and I can just stick in this for a long time. But I just sort of caution you about that because when you look at a dividend yield, it can often get inflated by low share price performance. So the share price goes down, you divide the dividend by the stock price, and then you get a higher yield. So you'll often see, for example, going back to this Market Index dividend yield scan, you'll see some things in there like AGL Energy, so very high dividend yield, that got absolutely smashed in a 12-month period. So just keep your eyes peeled for that. And I guess if you are thinking about dividends, and this is more important to certain demographics of investors, the ideal situation to be in is where you get capital growth as well as a strong dividend. So I'll just give you an idea. This is no way a recommendation, but this particular company is called Probiotech Limited. They do medical packaging. They've done a number of acquisitions recently. And so you've got quite a wide range here between support, which it found at around $1.70, and then resistance up here at about $1.48. So that's quite a large band based on various factors in terms of the company. But if you look into this company, they're currently paying a dividend yield of around 1.8%, I believe. This chart comes from TradingView like the rest of my charts. But just take a look at this. So if you look at the 5-year period, it's actually taken off on quite a bullish run there. So this is sort of an example of if you're chasing a dividend, it's also important to think about capital growth. So if you'd bought here, you would have collected dividends along the way on top of the capital growth. So I'd just be very cautious about just searching for dividend yields. It can be misleading. You may see your capital decline, and that will prop up the dividend yield price. And it can all be a bit tricky to navigate, but this could be an example of one of those sweet spot companies where you get both dividend and capital growth. And finally, I want to talk a little bit about macroeconomic factors. So one of the reasons the consensus, so-called consensus out there from analysts is that we're going to see strong earnings season, dividend payouts will be strong as a result. But they're sort of basing that on a macroeconomic picture. Now, I've got the Australian Bureau of Statistics unemployment rate here. You can see it's fallen off sharply. So this actually beats the forecasted unemployment rate that was released by the RBA and the Treasury. They were expecting it to be as high as 9%, I believe, through to December. And that was based on a pretty dire outlook related to lockdowns. So it's very interesting to see it coming down to about 6.6% for December, which is certainly a positive sign, but I'd also sort of caution you to completely rely on the ABS data here. So I've actually got an alternative measurement of unemployment and underemployment rates here. So this is coming from Roy Morgan's, which is sort of got a competitor unemployment and underemployment chart, and it got as high as 27.4 in late March. That was a record high. And that's a combination of unemployment and underemployment. And underemployment is really important to think about as well. Now, it's got a current reading for November of 11.9%, and this is the 7% from November from the ABS. So it gives you, I guess, an alternative view of the macroeconomic picture in Australia. So I just encourage you to just be wary of certain ways the ABS collects data. It's sometimes controversial, and you can look at their definition of unemployment on their website, and it gives a pretty loose definition of unemployment. You know, if you work 1 hour for payment in kind, the ABS may actually classify you as employed, even though you might be destitute. So it can be a bit misleading at times. So I hope you've enjoyed this look at macroeconomic factors. I hope you've enjoyed learning about some tools today. And then I hope you've enjoyed my comments about dividend yields and where to look for dividend stocks. So I hope you have a safe week. Be sure to mash that subscribe button if you want more content like this. We'll try and be bringing it out to you every week. And of course, check out Exponential Stock Investor, our stock tipping newsletter, which is specifically focused on small caps. It's a fantastic resource. We don't get every pick right, but we've had some excellent success recently. And if you're wanting to learn about how to invest in small caps, I think it's an unrivaled publication, and you can actually look into some of our returns from our selections, and I hope you find that convincing. So again, have a good week, and I'll speak to you soon. Cheers, bye.